It definitely sucks. I have no idea what I want to do.
I don't know what, I don't know what's gonna happen.
If you didn't know, I worked at Twitter and I got laid off when Elon Musk acquired the company.
I got laid off today after 10 years at the most amazing company.
Microsoft, one of the most powerful tech giants in the world, announced that it would lay off 3% of its global workforce, affecting approximately 6,000 employees. This marks the company's largest round of layoffs since early 2023, when 10,000 workers were cut. Microsoft stated that this decision was part of a strategic organizational realignment to better position the company in a dynamic market. While the company's share price dipped only slightly following the announcement, the message was clear. Not even the tech elite are immune to cuts. What's more alarming is that Microsoft isn't alone. Since the start of 2025, a wave of layoffs has swept across the tech landscape from Meta and Salesforce to UPS and dozens of smaller firms. The question isn't just who's next, but why is this happening everywhere? The recent layoffs at Microsoft are not an isolated event, but part of a much broader and ongoing storm sweeping across the tech industry in 2025. According to Economy Media and multiple workforce tracking outlets, nearly 29,000 tech jobs were eliminated in March 2025 alone in the United States. This is despite the fact that the U.S. economy in broader terms is technically in recovery and not in a recession. The cuts are happening across companies big and small, profitable and struggling. Perhaps most striking is the sheer variety of industries impacted. Layoffs have hit not just Silicon Valley darlings, but also legacy firms like UPS, which eliminated 20,000 jobs, much of which stemmed from its shift toward automation in logistics centers. Retail companies with large digital platforms like Macy's and Walgreens also contributed to job cuts, particularly in data analytics and IT support. Even healthcare systems long viewed as recession-proof have seen hospitals laying off IT staff and tech support roles as part of cost-cutting strategies. Surprisingly, the public sector isn't immune either. The U.S. Department of Government Efficiency alone reported a jaw-dropping 215 layoffs, with nearly 20% in technology-related functions. These included roles in digital infrastructure, cybersecurity, and cloud operations once seen as critical for the modernization of federal systems. And the trend isn't slowing. According to Layoffs.fyi, a site tracking tech sector job losses, over 111 tech companies executed workforce reductions in Q1 2025. This includes not just American firms, but international giants like SAP Ericsson and Tata Consultancy Services, showing that the layoff wave is global. While it's true that the overall number of layoffs is down 13% from the same quarter in 2024, the decline is misleading. In 2024, many companies were reacting to overhiring during the pandemic boom. In contrast, 2025's cuts are happening even at companies with strong earnings, indicating a structural shift rather than a cyclical one. The default explanation for layoffs, a looming recession or weakening revenue, doesn't hold up in 2025. Microsoft is profitable. Meta is profitable. UPS is profitable. The real driver behind these job cuts lies in the radical restructuring of the tech labor market driven by automation, globalization, and corporate financial engineering. Let's start with automation and artificial intelligence (AI). The pandemic fast-tracked automation adoption across nearly every sector. From robotic warehouse systems to AI-driven customer service, companies discovered that many roles could be replaced by machines, not just manual labor, but knowledge work too. In 2023 to 2024, AI models became sophisticated enough to handle basic legal work code generation and HR tasks. Now, in 2025, companies are scaling those tools aggressively to cut costs. UPS, for instance, publicly stated that their fully automated logistics hubs can operate with a 40% smaller workforce while increasing throughput. Other companies followed suit. According to McKinsey, up to 30% of current white-collar tech jobs could be automated by 2030, and firms are moving faster than expected toward that future. Meanwhile, the financialization of business decision-making has reached new heights. Today's corporations are under relentless pressure from shareholders and institutional investors to optimize every line item, including labor. A company doesn't need to be struggling to cut jobs. It just needs to be trying to boost its return on invested capital (ROIC) or meet a quarterly margin target. Layoffs are no longer just survival tactics. They are strategic tools for stock performance. This trend is especially visible in big tech. Amazon, Google, and Meta have all executed layoffs immediately following record earnings reports. It's not about staying afloat, it's about increasing efficiency on paper, even if that efficiency comes at the cost of thousands of careers. Then there's globalization, which remains a powerful force despite the protectionist rhetoric of recent years. The US tech sector is increasingly competing with and losing to international labor markets. In 2024, India's IT export market grew by 8.4%, while US tech employment declined by 3.1%. Companies like Rakuten and Infosys are ramping up hiring abroad, where a senior software developer costs 60 to 70% less than in the US with equal productivity. Remote work has only accelerated this shift. Now that geography is no longer a hiring constraint, many firms are defaulting to talent in Eastern Europe, South Asia, or Latin America, not because American talent lacks skill, but because it costs too much under shareholder expectations. Together, these forces are converging into something far larger than a market correction. It's a foundational realignment of the tech labor ecosystem, where cost efficiency, automation, and financial abstraction are increasingly replacing innovation, stability, and human capital investment. While thousands of American tech professionals receive layoff notices, a very different story is unfolding abroad. India, Vietnam, Poland, and Mexico are quickly becoming the new centers of gravity for global tech employment, and US companies are fueling that shift. In fiscal year 2024 to 2025, India's IT export revenue hit $194 billion, marking a year-over-year increase of 8.4%, according to India's Ministry of Electronics and IT. The US, by contrast, saw a 3.1% decline in tech employment, especially in entry to mid-level engineering and data roles. The divergence is no coincidence. India is not only producing more tech workers, it's producing cheaper, highly skilled, and increasingly globally competitive ones. Companies like Rakuten, Accenture, and Oracle have all ramped up hiring in India and Southeast Asia. Rakuten, for instance, announced a $100 million investment in expanding their Indian operations in 2025 alone, adding thousands of engineering roles that previously might have been US-based. Why? Because the economics are staggering. A senior software engineer in Bangalore can cost 60 to 70% less than a comparable employee in Silicon Valley or Austin without a meaningful drop in productivity. And thanks to remote work normalization post-COVID, those roles can be fully integrated into global operations with ease. This labor arbitrage isn't new, but what's changed is the scale and permanence of the shift. Before the pandemic, many companies balanced offshoring with the need for in-person collaboration or the perceived cultural and language barriers. Those concerns are rapidly evaporating. Collaboration tools like Microsoft Teams, Slack, and Zoom, ironically developed by US firms, have made borderless tech teams a practical default. Meanwhile, the US struggles to fill the gap left by these offshored roles. Retraining and reskilling programs are fragmented, underfunded, and often mismatched with actual market needs. Boot camps and MOOCs may offer certificates, but employers still favor experience, something recently laid off or junior US workers often lack. The result, a slow erosion of the US tech labor base, not because of a lack of talent, but because of policy inaction, cost pressure, and global competition that now operates on a 24/7 borderless basis. Beyond macroeconomics and corporate strategy lies a much more personal story, one of lost livelihoods, broken dreams, and widening generational gaps. As of March 2025, youth unemployment in the US stands at 9.6%, according to the Bureau of Labor Statistics. In stark contrast, the unemployment rate for workers aged 55 and older is just 3.1%. This dramatic disparity reveals a painful truth. Younger workers are bearing the brunt of the tech sector's restructuring, even though they were promised a digital economy of limitless opportunity. Graduates from prestigious STEM programs are finding that the jobs of tomorrow either don't exist or exist offshore. Entry-level job postings are flooded with applicants, yet employers increasingly demand 2 to 3 years of experience for what are supposed to be beginner roles. Many junior developers, analysts, and UX designers are caught in a cycle. You need a job to gain experience, but you need experience to get a job. Meanwhile, mid-career professionals, particularly those in their late 30s and 40s, are being replaced by automation or younger and cheaper global hires. Even for those with advanced degrees and years of experience, the job market is brutal. Many report ghost job listings, open positions that are never actually filled, often used to gather resumes or satisfy internal hiring protocols without real intent to hire. The psychological toll is growing. Tech workers who once felt secure are now battling imposter syndrome, burnout, and long-term career anxiety. Online forums like Blind LinkedIn and Reddit's r/tech layoffs are filled with stories of professionals feeling obsolete by 35 or too expensive to keep by 40. At the same time, retraining programs and upskilling initiatives are failing to keep pace. Federal workforce development funds have stagnated, while corporate-sponsored reskilling programs often lack clarity or guaranteed job placement. Workers are urged to learn AI or pivot to cybersecurity, but without a coherent national strategy, these calls feel more like platitudes than real pathways. This isn't just a labor issue, it's a generational crisis. Millennials and Gen Z who entered the workforce already burdened by student debt and housing inflation are now seeing their most stable and aspirational sector become volatile and exclusionary. They are increasingly disillusioned not only with tech, but with the broader social contract that promised upward mobility in exchange for hard work and education. The deeper concern, if these generations lose faith in the future of work, what fills the void? Gig work, AI-influenced creator economies, or a mass withdrawal from traditional economic systems altogether? Whatever the answer, it's clear that the current trajectory is unsustainable, not just for tech workers, but for the long-term vitality of the industry and society at large. If Microsoft, a global leader in innovation cloud computing and artificial intelligence, is laying off 6,000 people while still reporting strong profits, then we have to ask, what's the real purpose of this economy? What is the end game when growth is up? Automation is surging and profits are rising, but people are still losing their jobs. Technology was supposed to be the great equalizer. It promised to democratize access to knowledge, enable remote work, and liberate workers from the drudgery of repetitive labor. But in 2025, many workers are discovering that technology is no longer working for them, it's replacing them. What we're seeing now is a silent betrayal of that promise. The digital economy that was supposed to offer abundance is for many offering precarity. Layoffs are no longer a symptom of failure, they are a strategy for efficiency. Automation isn't freeing people, it's rendering them economically irrelevant. And globalization, once a sign of global cooperation, is now being used to quietly shift opportunity away from those who were told they were part of the knowledge class. This isn't about anti-capitalism, it's about balance. It's about asking whether we can continue to celebrate technological progress if the human costs are swept under the rug. What's missing is not technology, we have more of that than ever. What's missing is a coherent public policy response, one that ensures workers aren't left behind in the pursuit of digital progress. Because if we don't ask these questions now, we may not like the answers that emerge in 2030 or 2040. A world driven by automation, AI, and shareholder logic without people at its core is not a utopia. It's an efficient dystopia. The layoffs of 2025 are not just numbers. They're a warning one that begs us to rethink not just what we build, but who we build it for.